Good afternoon and welcome to the Gatewood Wealth Solutions weekly market commentary broadcast. This is John Gatewood, and with me today is our Chief Investment Officer, Aaron Tuttle.
John, thank you for having me again.
You know, every week I keep asking you to come back. You must be adding incredible value, the information that I need to know, and our listeners.
I'm a glutton for punishment. I will spend some time with you.
Well, I appreciate that. Well, there is good news this week, by the way. Baseball starts, and schools will reopen. There's a major debate over how this should happen. Virtual, all virtual, back to class with social distancing, guidelines, or some mix of the two. And the market continues to climb, as does the number of cases of the coronavirus, but hospitalizations and deaths have not increased at the same rate.
We have seen a little bit of a slowdown.
We have seen a little bit of a slowdown.
Not new highs yet.
We've also had more good news about vaccines. There's more improvement there. In fact, there are level 3 vaccine testings going on right here in St. Louis at Washington University and St. Louis University. The hotly debated enforcement over the wearing of masks enforcement is dividing people, but the administration now says it's patriotic to wear a mask.
Well,
so COVID relief funding is being considered by both houses before the summer break. There is just an awful lot going on, and the market continues to rebound.
it's certainly been a complex time.
Can you make sense of all this for our listeners today?
I cannot. But we do have a narrative.
That's good.
All right. So is that my
Take it
key?
away. That's your key today.
My mouse is not working. So we continue to monitor our timeline, and we'll give an update on the status of the industrial activity later in the call. But the good news is our next item for our timeline is looking promising. So we're excited about that. As you mentioned, new daily cases continue to capture the headlines. Last week we said we expected the peak to be this week or maybe next. And so far, it appears it'll be this week. So that's good news. Last Wednesday was the daily high of 66,300 new cases. But there was a report mentioning there was a 66% jump in testing. Now, it did not indicate the timeline or since, when. So it really wasn't relevant or important. Growth slowed on Monday to 55,800, which was a 4.2% decline with a 1.8% increase in the amount of tests. And that was from the previous week. So this was much better information than the previous report we got. So what it does is suggest that we are starting to slow for the new cases. And also the national trend in hospitalizations appears to be falling as well, which really, that's the good news.
That is the good news.
Now, when looking at the lag, the growth rate in deaths is not nearly as pronounced as it is with the daily new cases. But we can see a slight uptick in the data over the last couple of weeks. Yesterday was the first day where we had 1,000 or more deaths in a single day. That hasn't happened since early June. And I think we'll see a gradual increase on the 7-day average for the next couple of weeks due to that lag. Looking at which states are increasing, and Florida and Texas have hit the headlines often, but they're starting to slow. Hot spots like Mississippi and Tennessee and really all the other states are probably going to start gathering news. However, the states are not nearly as populated as Texas and Florida. We're in the middle of election season. Just think about how big those two states are and how much they matter in electoral votes to show you relative size for population. Because of that lower population, the new daily cases will probably begin to decrease at the national level. Now, I did not mention Arizona, though it's been often talked about as a hotspot, and it was a hotspot. But the reason I didn't mention it is because it's no longer even on the sheet where it's increasing. When we look at a 14-day average, it's now a decreasing straight. So we expect to see Texas and Florida to make it on this list here soon. Now, it is important to note, we are not seeing the growth rate in the deaths as commensurate or nearly as much as we are seeing that rise in new daily cases. And the Texas Department State of Health Services compared the number of tests to the number of deaths to previous seasons to just see how it turned out. The 2018 death rate for the flu, so it's not the coronavirus, was 0.04%. 2019, it was 0.034%. Now, as a comparison, the death rate is 0.01% for COVID. Now, this is Texas. It showed up much later in Texas than it did New York. These numbers would be much different if we were looking back in March or April. We've noticed that death rate versus new cases has declined. Also, this is really just thought of as a comparison when you see those headlines for the new cases versus deaths. To be more sure, more people are getting tests today than they were in the previous years, right? The tests were for 2018 would have been done for people that had very severe symptoms. That would have been the predominant sample of those cases. So the point really is, don't get too anxious about those new cases. The fact that we do see a slight uptick in the daily deaths does suggest that it is spreading, but it's not nearly spreading as much as the new case count indicates. So that's because we're testing people with mild to maybe no symptoms at all, versus whenever we were having a sample size in previous years. And you look, 164,000, 192,000 tests in 2008, 2.6 million. Right? So these are not apples to apples comparisons.
And probably most people who are even getting the flu back then weren't really going to be tested. So
right.
Maybe even in
a lot of the asymptomatic, a lot of the mild cases would have never gotten a test. So this is not to say it is or isn't more deadly. It's to say we're doing a much bigger, or doing a lot more tests relative to those deaths. So there's not necessarily a correlation for the increase in deaths, which we've been seeing in the numbers. Now let's move on to the economy. We did see another uptick in GDP due to retail sales, industrial production, and capacity utilization. U.S. retail sales rose for the second straight month in June as malls and restaurants reopened. Sales totaled $52.3 billion in June, which is nearly back to pre-pandemic levels. There was a pickup in big ticket items. People were buying autos, they were buying furniture, clothing, and electronics. Now, we are starting to see some recent rollbacks, so we may see some weakness in July, but I think the key takeaway here, John, is that consumers appear to be going back out and they're wanting to spend. We talked about pent-up demand in the market because people were at home. When we're seeing the market open, we're seeing numbers that resemble the pre-pandemic number on retail sales. Now let's jump to that industrial production. Remember, this is part of our timeline. Total output at factories, mines, and utilities increased 5.4% from the prior month. That's the biggest gain since 1946, or at the end of World War II, when we were turning from a war economy to a consumer economy. So big jumps. That's how big the increase was for this last month. But the chart below it shows that we have a long way to go to get back to pre-lockdown levels in the industrial production. Now, this means two things. There is plenty of upside still that remains on bringing the industrial side back up to speed, and that means that we're likely to see continued supply line bottlenecks or breakdowns. Remember, whenever the meat shortage or the slowdown because of the meat packing supply lines weren't able to get the box cuts to the grocery stores and how that affected the price. So we could see more of that, which is going to put upward pressure on the prices until we get full utilization of that industrial supply line back on. Meanwhile, housing starts came in at 1.19 million seasonally adjusted in June. That's a 17% decrease from May. We're still a little ways to go to get to the previous highs in this chart, but that is a substantial increase. Now, the last numbers, we love to look at money supply numbers, right? And when we look at money supply, we've been historically looked at a 13-month money supply growth, and that fell from 62.6% growth to 62%. The decline really is minor compared to the bigger picture. And what's the bigger picture? $3 trillion has been pumped into the system over the last 3 months. But on a 52-week basis, the money supply climbed this past week from 24.2% looking back 52 weeks. Now it's growing at 24.8%. We can see that here in this bottom chart here. In other words, there is a spectacular amount of new money in the system. This new money alone, I think, could fuel the stock market for at least 6 months. But the expansive monetary policy may not be over. The Trump administration is preparing another bailout that will be launched, estimated around August 1st. No doubt this is going to be another multi-trillion-dollar bailout, which will be monetized by the Fed. Why? Because the government doesn't have the money to pay for these bailouts. It's going to have to use the Federal Reserve to increase the money supply. Now, sources familiar with McConnell's proposal will include a heavy emphasis on education spending. There's probably a really big need to retool the way education is being delivered, considering all that we've gone through. A widespread liability protection. This includes restaurants, hotels, hospitals, universities, school districts. Now, many Democrats are strongly opposed to this, but McConnell has said this is a red line issue for him. Whether it's a right or wrong, depending on what goals or the way that you're evaluating it, whenever you evaluate it from the economy standpoint, this is certainly going to help the economy, because there's going to be a lot of business owners that are not going to be concerned about getting a few more people into the restaurants, or what's going to happen where they could get sued for the coronavirus. So that's going to make them more comfortable and reopening and trying to get back to normal. Like I said, there's other things that you could debate. There are other ways that you could measure whether that's prudent or not. Now, increased funding for COVID-19 testing. I found this one as a little bit surprising, because I would figure the Trump administration and the Republicans would actually want to drop the amount of test availability so they could get some of those new cases out of the headlines. But they have this in the bill. Extension of the Paycheck Protection Program. Now, this is not anything that they're going to add or put more money out there. It's basically allowing for the money that's already in the system to be better used. There's a the tax cut. That's having a renaissance moment. It is in the bill, apparently. And there will be no additional money for state and local governments. But there will be some relaxing of guidelines on how the money that is still left over for the CARE Act, how the states can get access to that. With all this extraordinary monetary policy, new stimulus coming out, the Fed is likely to let inflation run hot. Federal Reserve Bank.
That's the key.
That is the key. Federal Reserve Bank of Philadelphia President Patrick Harker is quoted in a Bloomberg article saying, "I don't see any need to act anytime soon until we see substantial movement in inflation to our 2% target, and ideally overshoot it a bit." Meaning the lower inflation numbers in the past, because we haven't seen a lot of high inflation numbers, will be used to soften the higher rates in the future. In short, if we see inflation, the Fed is unlikely to put the brakes on just because we get over that target. Now, last week, we discussed Aristotle's characteristics of money, and money is the lifeblood of the economy. We concluded that there was no specific thing that is money per se, but items, typically commodities, have served the role of a medium of exchange throughout time. There were 4 criteria that make a good currency, and that is durable, that it's lasting, that it's portable, it's easily carried, but really, to be more precise, it's easily transferred. Divisible, it can be made smaller or larger without degrading any of those other qualities, and that it has intrinsic value. However, we first needed to determine what makes something intrinsically valuable. And we discussed the value paradox. Why is it that diamonds are more valuable than water when water is more useful than diamonds? Any explanation was that, or a earlier explanation was that the value is derived from labor input. This was put forward by Adam Smith and was also held by Marx. So there was broad appeal on this idea. However, it was incorrect. And this becomes obvious when we consider diamonds and water and simply change the location to a desert. All of a sudden, that use value reasserts itself. So how do we solve this puzzle? Well, it was solved by three people simultaneously. Leon Walras, William Stanley Jevons, and Carl Menger are all part of what is known as the Marginal Revolution, or what is called marginal utility theory. Walras and Jevons used a mathematical approach. Walras introduced the UTIL, or measuring human satisfaction based on indifference curves or utility curves. And many people may be familiar with that. He also introduced the idea of general equilibrium. And when we get into mathematical economics, this is the cornerstone of it. Now, Jevons goes on later to influence Irving Fisher. And people may not be familiar with him, but he is a very big person in the economics world. Fisher is the source of indexes such as the Consumer Price Index on how to measure inflation. However, we're going to build off Carl Menger's work. He championed a causal realist approach and determined getting some messed up. He determined the value is subjective. Basically, value is different for everyone. Now, this is counter to Aristotle's claim that values were outside of man and the trade needed to be equal. This subjective value theory gave Menger some insight on the origins of money, or how money arrived in the system. Eventually get my computer to work here. The causal realist approach basically starts with what many call, and we're familiar with, the human condition. We are fragile, finite, and we are always in some type of state of suffering or want or uneasiness. No matter how good it is, we always feel like we have some uneasiness, right? And this is juxtaposed as having God-like attributes. We are not able to turn stones to bread or water. We're finite beings. We have purpose and vision. We are forward-looking creatures, and we are seeking to lessen our uneasiness over time. How many times have our listeners heard the market is a future-oriented index, right? Those are our plans out in the future, and it's telling us how we're doing. Now, we construct some type of solution to achieve those long-term goals using scarce resources, and we must economize to try and bring our vision to reality. Now, ultimately, the value is based on these goals or ends that we're pursuing. Therefore, the scarce resources will derive their value relative to their ability to alleviate the suffering and bring the goal closer to completion. Now, I'm not trying to be mystical here, but I think it has a color of a religion. Even though when you look at those historical thought experiments, whether it's turning stones into bread is usually used, or here diamonds to water, or once again stones to water. Think Moses striking a rock is when Satan tempted Christ to turn stones into bread. They all reflect biblical narratives. And now, why is that? Because ultimately it's both religion and economics are trying to deal with the human condition. They share a topic. Now, let's stay with our water and diamond thought experiment. Imagine you're in the desert and you have 7 units of water. All of a sudden, that diamond that dropped in value. But why? Well, let's imagine it takes 3 days to get out of the desert. Each new unit of water would be assigned an ordinal ranking. If 1 unit of water is 1 day of survivability, you would set aside the first 3 and consider them most valuable. They would become a single good, where that good would be, or that end would be, getting out of the desert. Notice you're not ranking the water as a whole, but each individual unit of water. You just need 3 units of water. You could take any of those 3 units and move it around. But what you're doing is you're determining what end you would use those units for. The end is how each unit is being valued. Each additional unit is a lower break value. So if we start out with the first 3, that's getting out of the desert. After that, the next unit, food preparation. Maybe the next unit is pouring water on your head, followed by washing the sand off, and finally making rainbow auroras to entertain yourself as you leave the desert. I know that's probably higher up for you, John. Maybe that's the first one. Now let's bring that diamond back into the experiment. Imagine someone has no water. How much water would they be willing to exchange for the diamond? As someone who possesses sufficient water to get out of the desert, I'm likely to exchange the water for the diamond, since I would be buying that diamond for cheap, and I'm going to be able to get out of the desert, and I'm going to really be able to use that diamond. Not only can I replace all the water, there's all kinds of other things that I will be able to get. So I am buying it cheap, and I'm knowing that I'm going to be able to sell it dear. That's a major part of how economies work. Now, at what price then would this transaction occur? Well, first, at least 3 units, because the other guy is going to bargain hard for the 3 units of water. So really, it's all going to depend on negotiating skills for each person. But the price is going to be food preparation. Who values food preparation more than the diamond? You either value the food preparation more than the diamond, or vice versa. And we have to have different values, right? Let's say I value the diamond more than I do the food preparation, and you value the food preparation more than the diamond.
Now, Big Mac.
What's
the
that?
Big Mac.
The Big Mac. That's right. The Big Mac. That means we're going to trade. Now, this is going against the idea that trade was equal, right? Because I valued the diamond more than the food preparation, but you had the exact opposite order. So we need to have a market to clear. We need to have different equalities on those items. So we have to have different ranking values. So where are we? Now, it is instructive to note that this whole concept is the source of our supply and demand curves. As the supply increases, as in more units of water, the price of the unit, each additional unit, drops. As the demand increases, the higher the trade-off value. In this example, with the 3 units of water or less, the price is essentially infinite. I am not going to give up the 3 my last 3 units of water for anything, right? There's not going to be a price.
Get out of the desert.
Right. The price would be infinite. Now that we have an understanding of value, let's look at a primitive economy. We have a society of fishermen here. Each person procures their own consumption through the labor of fishing. Now imagine one of the fishermen is a dreamer. One evening, he sees a vision. He sees more fish out there in the deep and less fish near the shore. Why? They're all fishing near the shore, and you can get a lot more fish out there. Now he dreams of a log floating in the water near those abundant fish. Basically, he has envisioned a boat, and he would be able to catch a lot more fish if he was out there further out on the boat in the water. However, to build this boat, he would first need to set aside enough fish to sustain him while he constructs the boat, or he would need savings. And that savings would be for investing in capital, the boat, for an increase in future consumption. So the whole point of this is to increase that consumption component because it's not the boat that you want, it is the increased consumption. So, and this would also take some risk by spending time building the boat. These are all important factors of of the economy. Now, while constructing the boat, the fisherman notices that it takes him less time, and it's actually safer to build the boats and trade them for fish, meaning there is a realized price of the fish to boat. He begins to specialize the division of labor. This is one of the theories that Adam Smith got very, very right. It is made possible through direct trade that you get X number of fish for X number of boats. Now, all are able to get more fish with this, with less work now that this boat is in there. And this is freeing up time. And with the additional time and really a full belly, one of the fishermen noticed that wheat grows from seeds. He decides to grow wheat, and for this story, Deus ex machina, we discover the recipe for bread. Now, like the boat builder, he begins to trade for fish. Everyone is eating fish and bread. Well, not everyone. The boat builder would like to trade for bread, but the farmer has no use for a boat. He stays on land all day. They do not have what's known as a coincidence of one. But being clever, the boat builder realizes that he could trade his boat for X number of fish, and the X number of fish for the X number of bread or wheat, the fish. Boats and bread are now valued in fish. We have a currency or a medium of exchange. Now, further time passes, and the boat builder, he's very ingenious. He adds a glass bottom to the boat. I'm not sure where he got the glass, but nonetheless, fish production skyrockets. However, people are eating bread too. So demand has decreased because of alternatives. You have fish, you have bread. And it takes more and more fish to buy the bread. The farmer has so much fish that he begins to throw it in the wheat field as a sacrifice to the wheat gods. Wheat gods seem pretty pleased by this because wheat production increases. He's become very wealthy and has more leisure time, which leisure time is also an economic good. He begins to accept boats for wheat so he can enjoy some time out on the water. Now, the boat builder's daughter is sleeping under one of the glass bottom boats and wakes up and looks at the sky. Under the glass, she notices the sky looks much bigger. Also being clever, she makes some adjustments and invents a telescope. However, no fisherman sees the value of the telescope. She notices the wheat farmer, though, out on the water when she's viewing through her telescope, and she shows the novelty to him, and he happily turns over a large supply of wheat. He has more than he can consume, and there's just one of these. It's a pretty cool item. She accepts it knowing that it stores well, or the wheat stores well, or it's more durable than the fish. It's easily divisible, right? Grains of wheat can be divided a lot further than fish, and has value, at least certainly more than the fish. Remember, the fish continued to drop in price, or what you would trade for them. So it's just a matter of time before someone finds a new commodity that actually better represents those four characteristics of money. What's happening is this is showing how a currency or a commodity as a money can find its way as a medium of exchange. And historically, gold and silver were the end of commodity as a money, as a medium of exchange. Now, next week, we'll review gold currency. We'll review where we are today in this process, how we continue to use these different characteristics to make changes and enhancements to money, as well as the idea of cryptocurrency. Can we take these four characteristics and have an understanding what does Bitcoin have to do, or how may it play out in this ongoing social experiment for money that we are in? Now we're getting to investment themes. Really, there's no change in our theme. We still think inflation risk is high. We favor equities over fixed income. We favor the U.S. market, and we favor technology. We're bearish on commodities, so I can't say that's true for gold. We do think that makes sense at the moment. Real estate and international, we're bearish on. We also really continue to see that residential move away from large cities out to more the suburbs. Now, let's look at price points. The next resistance level for the S&P 500 is its previous high. We're at striking price of the all-time high for the S&P. And the market has been marching up since we crossed that golden cross, or when the 50-day moved over to the 200-day moving average. And we had mentioned that we thought this from a technical standpoint would be a very good sign, a very bullish sign that the market would want to go up. And it's been pretty much on a straight march up since that has happened. On asset class tilts, John, we don't have any changes here as of yet. Now, we've been watching the dollar, and we're actually becoming very concerned about the dollar losing value. And we're going to discuss some of the changes next week. It is coincidence, but it's timed well that we're going to be talking about gold as a currency, and we're going to be talking about the dollar possibly losing some value going forward. Large cap growth and technology have reasserted themselves after slowing the last couple of weeks. And right now, the technology sector are reporting earnings. There was a beat on Microsoft for revenue, but there was a small adjustment and a sell-off. It basically is neutral for the day. That the slowdown in tech, though, over that time period did cause strategies to lag the bench last week. But so far, it has been making that back this week. John, we're entering that question and answer time, so I will turn it back over to you.
Well, we've got some questions here already. So one of our listeners says, despite the trade deal efforts under the current administration, the U.S. has been taking more stances against China. They ordered the Chinese consulate in Houston to close. They prohibited businesses from being done with Chinese affiliates in Hong Kong. They accused Chinese hackers of stealing vaccine research from the U.S. With these tensions growing, what are your thoughts on the impact this may have on the market and the economy?
Well, I think we have entered a new Cold War, and hopefully it only stays as a Cold War. And there's probably those accusations are probably true just as much as the accusations against the U.S. Probably have some truth to them as well. We have two very large powers that seem to be kind of separating. Now, what we don't see, at least until the election, is really any trade policy being decided. So then you got this tit for tat type of issues on how they're going to deal with each other. The U.S. also has publicly said that they are going to back Asian countries that have a claim on the South China Sea. So this is probably going to be the tension building between the U.S. and China. Now, out of that tension, we've talked about automation. We talked about it last week, where we are dependent upon a lot of supply chains originating from China. And because of this tension, we do think there's going to be a lot of onshoring of the manufacturing that we did originally export. Now, exporting manufacturing was not that difficult. It's probably not that difficult to onshore it and bring it back. The issue is labor costs. Well, labor costs have been going up in China as they've become further and further developed, but the U.S. is likely to deal with that increased cost through automation. So that these are all part of the long-term investment themes that we are looking and trying to be ahead of because of these issues.
Yeah, another question we had is that a listener says that many restaurant owners have tapped the federal Paycheck Protection Program and negotiated breaks with landlords. Many now see the PPP money as being spent, and landlords who offered rent deferments now want to be paid in August. They also state that 15% of all restaurants in California have closed for good. Can you comment on this fallout as local communities begin shutting down the economy?
So one of the things that we talked about is we believe this is more like a natural disaster than a typical recession. However, the longer these the economy stays closed, the more long-term more businesses that are going to go out of business long-term, and employment is not going to be there. So it is certainly something we want to pay attention to. However, though the restaurant industry is probably the largest employer, these are not very high-paying jobs or very high productive jobs versus the broad economy. So it shouldn't derail the economy. That's not to say that the business owners have not had a bad hand dealt to them. And a lot of it was the government on these shutdowns. So I'm not trying to simplify or ignore their issues. I'm just saying from an economic standpoint, it's probably small. Also, opening a restaurant, majority of them do fail. So once we get through this, I wouldn't be surprised to just see a lot of new restaurants start to come back online, probably name something, have balance sheets cleaned up, so that we will get back. But then once again, that all depends on what the new normal looks like whenever we get to that position.
Well, let's talk about the future of universities and local economies that support them. Many communities are built around a local university, which also attracts retirees who enjoy the lifestyle that these communities represent. With many colleges already stretched financially, how will the decisions around opening affect universities and their local economies?
Well, they're certainly going to affect it. The universities have really put themselves out over the last decade as an experience. And many of them are coming in with a virtual online class. Well, that isn't an experience. And the quality is probably not nearly as good, but you don't have all the amenities that have been so attractive and also have driven up price for the universities. That experience, I think, is going to look different. Now, who's going to be hurt by it? Well, it's probably not going to be the very big names, right? Harvard, Yale, these have enormous endowments. They are not very dependent upon it, and people will pay high ticket prices. I don't think there was a change whatsoever on the tuition cost for Harvard, even though it's going to be online. I don't know why people would pay for it. So I think the very large names are going to be able to make it through. Also, the community colleges, the smaller names that really were a bargain and a little bit more local, are probably going to adapt well as being that low cost option. So I think they will be okay. And they're probably more able to adapt to the new environment because they were already geared towards people that were busy and were not looking for that experience. So then that leaves that middle ground. I think that's where the struggle is going to be.
Well, you were mentioning that there is the talk of large economic subsidy for universities or education as part of the new bills. But universities have essentially been subsidized heavily by federal dollars over the last 20 years, which has helped push up tuition, expand capital investments with the university structure so that students could have that college experience that you're talking about, all of which is being challenged now by the pandemic. So now that Congress is once again considering financial support for these educational institutions, what are your thoughts on the proposed programs that they have?
Well, so I am a free market guy whenever I come to this. Most of the problems, let's say the high tuition cost, and it's high. It is causing a problem for the millennials. It would not be nearly as high if the government wasn't backing up those loans to begin with. Now, the sentiment is right. You want people to be able to get access to it. But the universities know that the students can get a loan no matter what the price is, knowing that they can't file bankruptcy. And they have used that to increase the price of tuition, oftentimes to buy those, to add the experience component. So I don't know what the regulation looks like, but I do know the past of the government, and they tend to, whenever they're trying to solve a problem, the unintended consequences are often exactly opposite to what they're doing. Do we need changes in the education system? Yes. It would probably be better to let the market solve that, because the heavy debt load that the previous policies have put on the millennials has certainly made a big impact on their ability to participate in the economy.
Well, let's talk about it, because student loan debt now, the total amount is larger than the total amount of subprime mortgages we saw in 2008, and we saw what happened with that. So what is the longer term impact that this will have on the economy and the market?
We've been seeing it. So we're not getting a lot of the entrepreneurs out of college because they have a heavy debt load, right? They have to get a job to service that debt. They can't take the risk. They can't eat ramen and noodles and keep their apartment low while they try to start a business. And I'm speaking in general terms. There's always going to be exceptions, right? But it has definitely been a roadblock in the way for a lot of the millennials to be able to just really tighten their belt and try to start a business. So it's definitely impinged the entrepreneurial spirit. But let's talk about the debt load that they're servicing. How easy is it to start a family whenever you have large debt loads to service from the university? It's going to be different. We've certainly seen a trend with the millennials where they're having children much later. They're also purchasing a home much later because they don't have the disposable income that many of their older siblings in Gen X or maybe their parents as baby boomers had when they're leaving. So it's far more difficult to try to get in a new house. And millennials have been made fun of this whole time, but it's not them necessarily being lazy. There are legitimate differences that the millennials have had to deal with. And it's been one of the reasons the economy has been more sluggish, because if you're buying homes, you're buying furniture, you're buying all the other goods that go into that, and you're starting families. And that's a major driver, at least on the front end, as you get your household going, which is a stimulus for the economy.
So Judy Shelton and Christopher Waller have been now nominated and confirmed by the Senate to be the Fed's Board of Governors, to be added to the board. There's also been some controversy, quote unquote, whatever that means in terms of their views, but how will their views impact Fed policy going forward?
I don't think it'll impact it very much at all. They've been criticized because they've spoke favorably of the gold standard. I promise you, they're not going to come out and advocate a gold standard. Their positive affirmation of the gold standard dwarfs what Greenspan's. He wrote a paper when he was running around in the Ayn Rand circles as an objectivist that was saying we need to go back to a gold standard. They make him the Fed. He expands the balance sheet. We never hear about a gold standard again from him. And he was a much more hardcore believer than these two. So once you get into that position in power, why would you ever restrict or limit the amount of power? And what is the Fed's power? The Fed's power is to be able to create money to move all the levers. Doesn't matter what new lever it is, it's ultimately funded by the expansion of the money supply. Now, there may be different degrees. So it's not a matter of kind, it's a matter of degree, right? Paul Volcker let the interest rates rise by slowing the growth on money supply, and it got all the way up to 21, 22% at prime. One, we can't do that today at 26.5 trillion, so we're not going to get another Paul Volcker. But his policy was certainly different than Burns as the previous chair for him, where his idea was to try to grow out of the debt problem by inflating it away. Sound familiar? And depending on what your bent is, will depend on how aggressive or how accommodative you want to be with monetary policy. But at the end, the only tool that the fundamental tool that the Federal Reserve has is to increase the money supply by creating more money. They're not going to come in and change back to a gold standard because that would remove power from them.
Now, one of the things you were talking about is you said that in the new subsidies that are being proposed, there's nothing for the states. And when you look at the amount of debt that has been accumulated by cities across the country by issuing municipal bonds, and all this has really been done through a prolonged period of growth in the economy. Now, city budgets have just been shredded by the pandemic. Mm-hmm. So what is your forecast on municipal bonds going forward? Will we see bankruptcies in this space?
Well, we still hold municipal bonds in portfolios. And the reason is if you look at what the Federal Reserve said they will purchase, municipal bonds are something that they would purchase. So it may not be a direct bailout, but they could do it indirectly by supporting the municipal bond market by buying it, and they probably would. But there is a problem with these, with most states, but they have high debt loads. One of the things that they did is they borrowed to fund pensions. You should not, company, government, never, ever, ever borrow money to fund pensions. It's a bad idea. And the only way to solve this, if they can't be bailed out, is to increase taxes. New York is actually thrown out an idea of taxing not realized capital gains on stocks, but unrealized. So if your portfolio went up in value and you're in New York, you're going to get a tax bill for that increase in portfolio value. Well, you know what's going to happen. People that are wealthy are going to leave the state and they're going to go to other states if that's the case. So they're actually going to shrink their tax bill trying to figure out how to make the budget balance. It's just not going to happen. One of the things that we've talked about before with this move and change from for demographics moving towards the lower tax states, whether it's Tennessee, Florida, Texas, moving away from California, New York, Massachusetts, is what is that going to do to the demographics of the country? Now we're in the election season, so we always talk about electoral votes. Think of how big some of these states are, and if all of a sudden some of the people are leaving New York and they're bringing their politics with them, because we don't know if it's going to be mainly the conservatives that are fed up and Texas becomes more red, or if it's just a sample of everyone in New York and they're going to bring their politics with them. What does that change? Does Texas become purple? Does it become blue? What about Florida? And what implication does that have for elections going further? It's still unknown. One idea and what we're trying to try to understand or try to get an early warning on it is we're starting to pay attention to local elections, because then you'll start to see votes going a certain way to maybe give us an advance warning on how things are shifting within the way people are spread across the country.
Yeah, I mean, we certainly see that there are trends that are developing. They're not clear, but I know that taxes, things like that, are certainly driving people to other states. But it'll be interesting to see how that does fall out over the next 5-10 years as the demographics change.
And remember, one of the things with the tax bill change was the removal of state and local tax deductions. That probably has only expedited this component. Now with the budget, so the states were already in trouble, but now whenever they have very low tax revenues, and that's one of the reasons that we don't think that the economy is going to be shut down the way that it was in April, is because it financially devastated the states. That's why we think it's this mask mandate where the economy can continue to move in. I walked into Whole Foods just a little bit ago and I didn't wait in the line anymore, right? Because they mandate masks, so they're not doing the line waiting as before. So that means more people are going in and shopping. So that seems to be the current political solution.
Now, U.S. home sales rose more than 20% in June.
Yes.
And of course, that's fueled by the low mortgage rates and the increased economic activity and people wanting to now move away from the city.
Right. You want a bigger home. You don't know if you're going to be in your home quarantined again, and you certainly want a bigger space. And well, now you can work from home, so you're not worried about where it's located necessarily, because you may not have a drive.
So now the question is, what impact will there be on the market and the economy, let's say, if this does slow? Or are we headed to another 2008 like real estate bubble because prices are going up? Homes are not on the market very long.
No, they're not. And there's very low inventory on the market, so not everyone is moving either. Could it be a perfect storm? Yes. I don't. At the moment, I don't think it is. I think there's a real demand there. Interest rates are low. I don't think the Fed is going to allow them to rise, and they can continue to print money to keep them low despite inflation. And like I said, I think a lot of people just want a bigger home after what we've gone through. Also, if inflation's there and your house is appreciating at 5 or 6%, or even 4%, but you're paying 2 or 3% on your interest, why would you ever sell? Those are assets that you would continue to go after. I would expect that the housing price would continue to go up. Maybe if there's a bubble, my bet is that at the end of that bubble, the house price would be much higher than it is today. Because you get that run up and you get the crash.
So usually at the crash, at the crash price, it could still be higher than what it is today.
Right.
Yes. So another thing we're seeing is that tenants are looking to restructure leases for less space or even walking away from leases altogether. Can we expect a long, deep decline in U.S. private office construction given the change in the work environment from work from home trends or other hybrid models going forward? And what will this mean for allocation of the portfolios to real estate as an asset class?
I think it's still too early to make a call on that. You can make a bear argument, you can make a bull argument. As you know, there are plenty of people that are looking for more space. And part of it is just considering, hey, we need the social distance in our offices. So they had a smaller footprint and they're looking at expanding because there's still some need to have people gathering. So they need more floor space. So that actually may cause an increase. Initially, that is what we're seeing. I think it's way too early to make a call of that's what's going to happen going forward. I do also think that there may not be a dominant work from home thing where people only work from home, but I expect to see an acceleration of working from home more often. There is productivity, at least whenever you have a day or two throughout the week. I think you would lose some of that social capital that's built up by being in teams and close environment. So I think it's a mix of both. And that may reduce the need for a lot of space because you could just kind of hot seat. You'd have different workstations that people could access. And on Monday, Tuesday, Wednesday, this is your seat, but maybe Thursday, Friday at somebody else's. So maybe you don't need all the differences. So once again, I think it's still too early to tell on that.
Well, I know we have some other questions here, but we're out of time. We're actually over time. So first of all, I want to say thank you once again today. You had an amazing presentation. I look forward to hearing the continuation of the whole concept of currency, because the whole purpose of that is really to help our listeners understand why we are where we are today from a monetary and fiscal policy, because those are two absolutely essential elements to understanding how to manage your investments and understanding how you organize to preserve your own wealth.
And understand why we have, because we're getting a lot of calls, and if you read the headlines, there's a lot of people that are bearish and think this market's overvalued. Why is it that we're contrary? And building this up to explain why is what we're working to explain why our investment theme is what it is.
Well, I want to remind our listeners that discussions around any specific stock or mutual fund is not an endorsement to buy or sell, but simply commentary based upon each commentator's opinion. All investments have risk, and past performance is not indicative of future results. I have to say that every time. You'd think I know that by now. But I also want to remind everyone this weekly broadcast is open to the public. We welcome the opportunity for you to share the links to our broadcast on social media with your friends and family. They are more than welcome to listen and learn our perspective on the market and the economy. So thanks again for listening in to today's broadcast. And as always, if you have any questions, please contact your lead advisor or any member of your team. We are here for you. So long for now.